Hi, Ken Schisler here with Integrative Lending. We're going to talk about stated income loans today, what they are and what they are not. I'll give you kind of a complete history of what they used to be and what you can actually get for your clients or for yourself today. So let's start with a brief history of stated income. Originally, stated income loans were created for the self-employed borrower that had good credit, sizable down payment, and a fair amount of reserves in the bank. Leading up to 2008 meltdown, you could obtain 100% financing with a 580 FICO score without documenting your income or your assets. They also extended this to W-2 employees. Obviously, things got a little crazy and was one of the big things besides subprime loans that led to our meltdown. Banks were looking for more loans and kept reducing the amount of documentation you had to provide. I knew there was something wrong in 2008 when I saw Bear Stearns, which we all now know is defunct, released a 100% option arm with stated income and stated assets. So from day one, the borrower was underwater with no proof that they could actually pay the loan. Stated income is now back. It's returned to the marketplace, but it's a very different form than what we saw in 2008. We're basically back to the sensible approach from a risk perspective when it comes to not providing income documentation. So on that note, today's stated income, we've got portfolio lenders who don't sell their loans to Fannie Mae or Freddie Mac, and they've come back on the marketplace and have started offering these products again. And it's been about 18 to 24 months. When they first came out, they were very restrictive. It was very hard to fit someone into that box. It's a function of the lender's risk tolerance and the Dodd-Frank Act, because the Dodd-Frank Act requires that lenders document the borrower's ability to repay when a loan is secured by a primary residence or a second home. For investment properties, this rule doesn't apply. And along that note, there are many other types of loan products for stated income where lenders are offering investment property loans without any income documentation at all. The flip side of that is that these loans are known as private money, hard money. We used to call it hard money. Now there's a new name, private money. It sounds better. Those rates range from 7 to 12%, depending on the loan to value, the type of property, and they basically are underwriting the equity in the property. And by having a larger down payment or a lot of equity if it's a refi, that's what they make the loan on. But they want a high yield for that because their investors are searching for yield that they can't find currently in the bond market or the stock market. And they also charge a lot of points up front, anywhere from 2 to 5%. So it's those are a different animal. I'll talk about those in a later presentation. But for now, I'm going to focus on the stated income loans for primary residences. So there's a few lenders out there that will provide them. And I've used several, and I've learned which ones to steer away from and which ones to work with. So stated income for primary residences, the minimum down payment is 30%, and the down payment goes up from there depending on the loan to value and the credit score. You can see this basic grid on the right here. So a loan at 625 or under, you need a 680 FICO, which is an improvement. That used to be 720. Maximum loan to value is 70%. And you'll see it says max LTV and CLTV. That means there's no seconds allowed, no seller carrybacks, no institutional seconds. It's one loan, that's the maximum you can borrow. You go from 625 to $1 million, they'll do 65% LTV, still at 680 FICO. $1 million to $1.5 million, 60%, 700 FICO, and then from $1.5 million to $2.5 million, 55% loan to value with a 720 FICO. There's no prepayment penalty on this product. That's primarily because it's a primary residence. Prepayment penalties are illegal now under the Dodd-Frank Act. You'll still see them on investment properties, but On primaries, they're not allowed. The reserve requirements range from 6 months to 12 months, depending on the loan size and the number of properties the borrower already owns. So, for example, 625, under $1 million and 60% LTV, they only require 6 months reserves. But as a rule of thumb, you should assume they need 12 months reserves. Already went over the chart. That's for single family residences and planned unit developments, or PUDs. They will do condos and 2-unit properties, 2 to 4 unit properties, but those are at lower LTVs and a slightly higher rate. And we can, if you have questions on properties like that, you're always feel free to call me on that. It is a 7-1 ARM. They don't offer a 30-year fixed, but they have excellent caps. So they have a 1.25 cap. That means that the first adjustment period after 7 years, it doesn't matter where the index is on the ARM, whatever the calculated adjustment rate is, it can't go up more than 1% over the note rate. And then for any term after that, it's fixed for 1 year. The highest it can go up is 2% on the second adjustment period. And then the lifetime cap is that last number, 5. So the highest it can ever go is 5% over the note rate. And the good news is the interest rate starts at 4.75%, which is for a stated income loan in our current market, that's a very good interest rate. And they don't have any type of 0-point option, so you're going to be paying 1.5 points. But again, that's pretty reasonable considering the product type. Underwriting guidelines and documentation. It's specifically for self-employed borrowers. I get a lot of calls from people who they're 1099, so they work for a company, but they're technically self-employed when it comes to their tax returns. It won't work on this product, and I'll get to that in a little bit as far as the documentation that's required. But you have to have a business license for 2 years and a CPA letter, and 1099 employees generally don't have that. Technically, the product is available for a W-2 employee, and all you need is a written VOE from the employer that shows their income, and they'll go off of that. Don't really think about this product as a W-2 employee. I mean, for the pure fact that if you actually make that money salary, then why wouldn't you go full doc? And I can tell from getting lots of calls on this product that I have people who are trying to basically lie and say that they work for somebody and they really don't, or they are actually self-employed and they're trying to make themselves look like a W-2 employee. The lenders figure it out. Number one, it's fraud, and number two, you'll never get away with it. So kind of highlights here: credit profile, income documentation, and assets. Credit is pretty lenient. They want to make sure you can actually have 1 late payment on your mortgage or your rental history in the last 12 months. So we call that 1 by 30 in the mortgage industry. For rent, they're going to want 12 months canceled checks and a written verification of rent from the landlord. They won't take just a written verification of rent because they know that's easy to say someone's on time. They want documentation to back it up. So 12 months canceled checks to prove that they are making their payments on time. Reasonable requirement here, they want to make sure you have 3 open and active trade lines that have been open for at least 12 months. And the reason they ask for that is they want to make sure that your credit score, there's some validity behind that it's based on some experience. This part's actually pretty good. So when this product first came out, you couldn't have any BK, short sales, foreclosures, loan mods, nothing. Excuse me. They've recently relaxed that, so it's only a 3-year seasoning on a BK, 2 years on a short sale, 1 year on a loan mod, and 5 years for foreclosure. Keep in mind that most people who file bankruptcy, it's generally because they have a mortgage involved as well, and that is just like a conventional loan. If there's a mortgage included in a BK, then the 5 years for a foreclosure is the time frame that rules the roost, not the bankruptcy. As far as income documentation goes, there's still a little bit of documentation. This is primarily the lender wants to make sure you aren't just stating a number on your app, but it's also to satisfy Dodd-Frank. You need to have a profit and loss statement year to date. Doesn't need to be audited or produced by a CPA. It's unaudited, so the borrower can produce that. CPA letter verifying business ownership for the last 2 years and a 2-year history of a business license. So they won't just take a CPA letter because they all know people can cook those up. So they want to have a 2-year history of a business license to back that up. They also want 2 months bank statements. It's not a dollar for dollar calculation of the income, but they want to make sure that the deposits going into the business account line up with, in general terms, the P&L. If they don't, they're going to ask for more bank statements. But of course, as a loan officer and a broker, I would make sure that those things lined up before we submitted. And if they didn't, I'd want to get a longer history of the bank statements to make sure that they were in line. As far as the assets are concerned, generally 12 months reserves are required. If the LTV is less than 60 and the loan's under $1 million, then you only need 6 months. They will let you use stocks, bonds, mutual funds, vested retirement accounts, and the business account. But there's certain percentages of those totals that they'll allow you to use. So 70% of your current value of stocks, 60% of vested retirement accounts, 50% of the funds in a business account if the borrower is 100% owner of the business, and that's critical. You can actually use gift funds now too. Those are okay, but the borrower must provide at least 10% of their own money for the down payment if it's a purchase, and they want to use gift funds. All those things under the asset section, those are actually significant improvements over the last 12 months from when they first came out with the product. That's pretty much the summary of the product. A little bit more about integrative lending. Been a broker for 12 years. We do all types of loans: conventional, VA, FHA, jumbo, stated. They've got bank statement products now for documenting income. I always try to qualify my borrowers for a traditional non-stated income loan first, because there's more attractive rates and terms. And there's some, unfortunately, there's some loan officers that can't read tax returns or don't know how to configure things properly. So I'd say about 50% of the calls I get for a stated income loan, I'm able to flip into some kind of documentable loan, which provides them with better terms and fees. Thanks for listening. Plan on putting these out there once or twice a month, highlighting our different products. Love to help any of your clients anytime you have a question. Ken Schisler, Integrative Lending. There's my phone number and my office line below. Have a great day. Thank you so much.